Hi everyone, my name is Piterpakulski. Today we will continue building financial model of a clothing store, shoe store. We are building a chain of stores, so we have 40 stores in our chain. And today we have a very interesting task. We will be building the cash flow statement. So we just need some environment, some table where we will be able to evaluate how much financing we need, when we need this financing, how much of cash will be generated by the project by this or that time in the future. So all these answers will be given from the cash flow statement. So today we'll be building this very important statement. So guys, please like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I completely finish this model, I will give you all the links in the description of this video as well. So you will be able to watch all tutorials from scratch till the final overview, absolutely free one by one. First of all, let's very quickly run through what we did before during previous tutorials. So in our model we have 6 types of stores. They will be forming 40 stores inside our chain. Blue cells like these are the inputs, so we are playing only with blue cells. All other cells are formulas, so we're not touching them during scenario modeling. First of all, we have 6 types of stores, so let's dive into one of them. So in each store has 2 collections, spring, summer and autumn, winter. First of all, we are setting up when the collection, for example spring summer collections, gets inside the store, when the first revenue appears. Then we describe the product line for this collection, pricing. We can switch on and off different items from calculations. We have global and local coefficients for pricing, for future scenario play. Then we specify the sales plan for this collection. We have global and local coefficients for scenario play, for sales plan. Then we are setting up the level of manufacturing costs. We have global coefficients and local coefficients for manufacturing costs as well. Then we are setting up discounts for pricing for our product line. So this is the moment when we start selling our collection inside the store. Here it is. First of all, we have no discounts. Then discounts appear and they are growing, getting bigger and bigger. So here we specify the discounts level for the prices. Here we allocate the sales plan inside the timeline. So this is the moment when the collection appears in the stores. For example, we are selling 40% of items for the product line during the first month, 20% of sales plan here, 10% of sales plan here. So we are allocating 100% of sales plan inside this timeline. Then we are moving to the next collection, autumn winter, and here we're setting up the same inputs. Then we're allocating manufacturing costs. So here is the moment when the collection gets inside the store. These are 6 months prior to this moment. This is the cost, this is the manufacturing cost for this collection, and here we allocate in percentages these manufacturing costs during 6 month period prior to the moment when the collection we start selling this collection. This is the story for spring summer collection, and this is the allocation for autumn winter collection. Here it is, so we can play with allocation. Then we are describing fixed costs for these stores. So this is the actual cost, fixed cost items. We can switch them on and off. We have global and local coefficients for fixed costs. Then we're describing payroll, positions, people, amount of people on each position, salary per person on each position, on and off, bottom, global and local coefficient. Then we are setting up the investment plan. So this is the moment when the store starts operating. This is what we are investing in. This is how much we are investing in, and these are months prior to the moment when our store starts operating. So we can switch on and off different investment plan items. We have global and local coefficients for investment plan items. Then we are setting up the life cycle for this store. So this store can operate, for example, 2 years, 5 years, 10 years, and so on. This is the level of asset tax monthly paid. And this is how fast we are reaching the target revenues from the moment when we start operating activity of this store. This will help us to see if we have or do not have some operating losses inside our chain. Then we can describe 6 portraits of different types of stores. So we have 6 types of stores. Then let's go to the core. Here we are setting up the first year of our financial projections. Here we have global coefficients for all the pricing, sales plan, manufacturing costs, fixed costs, payroll, investment plan. Then here we can name our 6 types, these 6 types of stores. We can switch them on and off from calculations. And here we have a core, very important table, where we are setting up what type of store we are going to open, then when we are going to open this store. We can switch on and off this or that specific store, and this will later go to the cash flow statement. So we have 40 stores in our chain, and for each of them we can specify what type of store it will be. Then we are adding a loan, so we're specifying the amount of loan, term of loan, interest rate, a grace period for interest payments, grace period for principal payments, when we get this loan, year and month. And then we are setting up the management company. So we have 3 variants when a management company appears. The first variant is when we set up the first store in chain. The second variant is when the chain reaches this or that amount of stores. And so, for example, we will be adding in variant 2, we will be establishing management company when the chain reaches 15 stores. So we can set up the amount of stores in chain, and since then the management company will appear, starts its operating activity. And the third variant is manual, so we will be setting up manually when we're going to open a management company, so year and month here. Then we are setting up what variant we will be choosing, so we can switch on and off management company. And here we have fixed costs for management company. Here we have payroll for management company. Here we have investment plan for management company, asset tax for management company. And now let's move to the cash flow statement. So let's copy this table. So first of all, let's start with revenues. So revenues, this will be revenues. Let's go up. So I will be just searching for green lines. Here they are, revenues. So cash flow statement is a 100% automized statement, so we're not putting any inputs here. So let's extrapolate that. So these are the revenues. Then let's add manufacturing costs. These will be direct expenses. So these are the revenues. These are manufacturing costs. So now we are done with direct costs. Now we are moving to payroll. So we are moving to payroll. So manufacturing costs, fixed costs, this will be payroll. Payroll will consist of payroll from the chain plus payroll of the management company payroll. Let's extrapolate that. Now let's move to the fixed costs. So fixed costs we're gonna pull from the chain. Payroll, fixed costs. Plus fixed costs from the management company fixed costs. So revenues, direct costs, payroll, fixed costs. Then we are moving to taxes. So I will add a new small block of inputs here. Tax. Then here rate. So this will be the, for example, revenue tax, then payroll tax, asset tax, then for example, so asset tax I will put here, then profit tax, so these are the inputs. I'm coloring it with blue. These will be percentages. So revenue tax, for example, will be 4%, payroll tax will be, for example, 9%, profit tax will be, for example, 3%, and asset tax, for example, will be $7,000 monthly. We've already calculated asset tax, by the way. Let's delete it. So taxes. Revenue tax, then asset tax, so revenue tax, we will take revenue and multiply it on the rate, tax rate. Then payroll tax, we are taking the payroll, then we're multiplying on the tax rate. We will skip profit tax for now. Let's move to asset tax. So asset tax will be, this is asset tax from management company plus asset tax from the chain. So asset tax from the chain, okay, let's press enter. Now let's extrapolate this formula to the right. Okay. Now let's calculate, by the way, let's group it to make it more elegant. So data group, group, Here will be the result from operating activity. So this is the first important line that we need, because this will show us how our business operates itself without any burden, any external burden, like for example loan payments and so on. So we are taking the revenues minus direct costs minus payroll minus fixed costs minus taxes, and this will be the result from operating activity. Okay, so now let's group taxes. So let's move to a result from investment activity. So investment plan. So we have investment plan from the chain. So investment plan from the chain plus investment plan of the management company. So here will be the second important line. This will be the result from investment activity so I will just take this value with minus, because all investment plan in our case is 100% outflow. So this is the investment plan. Let's group it. So now let's move to financing activity. This will be equity. Maybe this will be the only line with inputs in our cash flow. Then we are adding our loan, inflow of our loan, then interest and principal payments. So principal payments, interest payments, and this will be the result from financing activity. So this will be equity plus loan inflow minus principal payments minus interest payments. Now let's extrapolate it. Okay, now let's move back to the taxes. We have a profit tax, empty line. So here we will write a formula. So if the tax base is positive, we will be calculating profit tax. If not, we will put 0. So if revenues minus direct costs minus payroll minus fixed costs minus revenue tax minus payroll tax minus asset tax minus principal payments minus interest payments is less than 0, we will put 0, otherwise we will take this tax base and multiply it on the profit tax value rate. So now let's hide taxes. Now let's add line called cash balance at the beginning of period and cash balance at the end of the period. So cash balance here is 0 at the beginning. Cash balance at the end of period will be the result from operating activity plus the result from investment activity plus the result from financing activity plus cash balance at the beginning of the period. Then we are putting this value, this becomes the beginning balance for the next month. So we are moving this value here, and then we just extrapolate this formula to the right. This will be operating, investment, financing activity plus beginning balance. Now let's extrapolate these two formulas to the right. So now this is the last line of the cash flow statement. So now we are done with cash flow statement. Now we can move, for example, to calculating financing needed, simple discounted payback period, internal rate of return, net present value calculation, and so on. So these will be the topics of our next tutorials. So guys, please like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. So at the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials, and when I completely finish this model I will put all the links in the description of this video as well, so you will be able to watch all tutorials absolutely free from scratch till the final overview. So thank you guys for watching, see you next videos, thank you and bye.